This is Larry, and I'm back again. And today, what I'd like to do is talk about what is called a call backspread. A call backspread's a bullish strategy, but it is a bit conservative. So, you want to implement this type of strategy when you're somewhat bullish on the underlying, but you want to limit your risk. And what you do is to implement a call backspread is first you're going to sell an in the money call or several in the money calls, and then you're going to buy twice as many out of the money calls. And the strategy can be done for a net debit or a net credit, or even money, depending how far out of the money, in the money, the price of the calls, and a lot of factors. But basically, instead of it's kind of like going long a call, but you're giving up a little bit of the middle. A little bit of the middle of the price range of the underlying is going to be a loss. And I think I can show you that if we go and we implement a test run and go to optionstrategies.info and implement a call backspread. So right here I'm going to give you the underlying price of 50. We're going to say the volatility, implied volatility is 25%. Interest rates we're going to assume are 0.5%. Now, I don't know if I mentioned this earlier, but all the options that we're buying and selling are going to be on the same expiration date, so it's going to be 50 days to expiration. So when you're implementing a call backspread, you want to have all your expiration dates be the same. And we are going to sell an in the money, or we're going to sell 5 just to, make it a nice round number of in the money calls. So in the money will be 45, because an in the money call is going to be below, the in the money call strike price is going to be below the underlying, where the underlying is trading. Excuse me, that's the premium. So you want to put the premium in there, and the strike's going to be 45. You want to buy twice as many, and the premium for an out of the money call is going to be less than an in the money call because it is worth less. You can, first off, you cannot exercise, or you don't want to exercise an out of the money call because you would be getting the right to buy. And so an in the money call is worth more because you can buy that underlying at a lower price. If you'd want to learn more about these types of situations and calls and puts and that type of thing, just head on over to optionstrategies.info, and we have a lot of good information about that. But the short is that this is going to be a lower price, and it's an out of the money call. I hit calculate here, and you can see the way this strategy plays out. As I mentioned earlier, as the prices are in between, or not, don't go down a lot, you lose money. But then when it goes up, you make money. And when it goes down a lot, you break even. It could have been a net debit or a net credit, but in this case, you're breaking even. And if I can show you the graph and how that looks, this is going to be 50 days out. You see that kind of straightens up a little at expiration. You have that, not losing anything. When you go down, you got your right at the strike price of the calls that you bought is where the maximum loss is at 5,000, and then start making money. And if it was to go even higher, we'd make even more. The profit on the callback spread is unlimited, and the amount of loss is limited, as you can see. So as I mentioned before, the callback spread works well on stocks that might be a little volatile, but you're somewhat bullish on them and you want to capture some upside, but you don't want to risk a lot on the downside. So what I thought we'd do is we'd look at Amazon, a stock that's been going up a lot, doing very well, recently had very good earnings, and it's a good company. So I thought we'd look at the callback spread, implementing a callback spread for Amazon. So right here, if we go to optionstrategies.info, our strategy analyzing tool, we'll use the price that Amazon closed at today. Underlying shares is going to be 0. We're doing 2 options. The first option, let's make the strike, we'll make the expiration date on these out to August 21st. The first option, though, we're going to have the one that we sell, so that's going to be in the money call. Let's make that strike at 5:15. And of course, you can also get option quotes at optionstrategies.info. So if you want to, compare where the options are trading before you do your analysis, you can do that also at our website. Let's use the market price, and let's sell one call, and then we're buying out of the money calls. So let's do a strike price of 535, so kind of even the whole thing out. Here's the market price. You buy 2. And you calculate. And there you see. Right there, it's a 20, so, a slight debit there on the downside. So you're risking when at expiration, so you can see kind of here, you're looking at, the way the options are priced, but I'm looking at expiration all the way out here to the 21st. And you can see once it hurts to a certain point, you're kind of losing money. You got that little middle where you're losing money, and then you start making money. So if you look, the graph, that, it's right there, and then there's that expiration. You see that little down. It's not as, in our analyzing tool, we put a lot more points in there, but you can see that it goes down in price. Look at some of the calculations here on the individual options. Cost there is, as you saw, is a $22. So there's that. Look at that. So it's kind of a, delta. And that's pretty much it. That's how you implement the callback spread. So hopefully this was fruitful for you. Hopefully you watched the whole thing and you enjoyed it, and visit us at optionstrategies.info. Until next time.